optimism about the trade negotiations, and then, of course, comments from the Federal Reserve Chief Jay Powell.
In the short term, if government shutdowns don't last very long, they have typically not left much of a mark on the economy, which isn't to say that there's plenty of personal hardship that people undergo, but at the aggregate level, the economy generally does not reflect much damage from a shutdown. A longer shutdown is something we haven't had. If we have an extended shutdown, then I do think that would show up in the data pretty clearly. I don't see a recession. I would say that if you ask me what am I worried about, I would say the U.S. economy is solid. As I mentioned, there's good momentum going into this year. The principal worry I would have is really global growth. If you look at Asia, look at Europe, you're seeing slowing in growth, and the question will be, how much does that affect us? So I don't think that the tariffs on either side have had much of a visible mark on either the Chinese economy or the United States economy. So in other words, Chinese exports and imports don't show any mark from that. And we have a $20+ trillion economy. The amount of tariffs so far just doesn't show much of a mark. So, and again, we don't do trade policy. We don't give the administration advice on that. I would never comment on the administration's trade policy.
Are you worried at the Fed about the enormous amount of debt the federal government has?
I'm very worried about it. But from the Fed standpoint, we're really looking at a business cycle kind of length. That's our frame of reference. And the long-run fiscal non-sustainability of the U.S. federal government isn't really something that plays into the next, the sort of medium term that is relevant for our policy decisions. It's a long-run issue that we definitely need to face, and ultimately we'll have no choice but to face.
Joining me now, Mahoney Asset Management CEO Ken Mahoney. The most important thing that Jay Powell said yesterday was the Fed will reserve. He is going to be flexible on the interest rate outlook. He used the word patient or patiently 5 times during that interview in terms of the path of interest rate increases.
Well, good, because he was impatient and inflexible before. Starting October 3rd with the speech talking about we're far away from neutral until December 18th of raising rates and saying, hey, we're going to be robotic and pretty much raise rates throughout the year and not work off the balance sheet. So it's good to see that he's flexible. He's actually dusting off his textbook from 1965 and looking at the real economy and real numbers and saying, hey, you know what? We got to pause this thing for a bit.
Ken, doesn't it show that Donald Trump won the battle? That when he went after them, suddenly they went from hawkish to dovish about 2019?
True, yeah. But, I think it's more than the president. The data points just definitely shown from mortgage applications to the markets to the spread curve, to the yield curve and so forth. Really showed the Fed that the Fed was wrong initially and the market was right about what's happening with
Ken, I know that your clients outperformed last year, so I want to look forward-looking into the first quarter, not backwards-looking, although I know you had a great... I know. So when you look at the government shutdown, the Fed, Brexit, China, when you look for the first quarter, because I don't want to just talk the next week because there's no Fed move until maybe March.
Sure.
What keeps you up at night of those type of things going on?
Well, again, I think the Fed, we could check the box that hopefully that's behind us. The government shutdown, I hope they could, get rid of this thing because there are some bottlenecks that are happening. I think China trade is really important. That March 2nd deadline, which is the 90-day part, comes up. And the way Trump negotiates, he'll probably bring it right to that March 2nd point. So I think that'll make investors nervous. I mean, right now we have a nice rally up, 9% in the last 10 trading days. We're actually selling into this rally a little bit, keeping some cash on the side in case we get a whoosh down for any of those political reasons or any of those geopolitical reasons.
And I know Lindsay wants to chime in, so go ahead.
Yeah, what is the probability of a downturn from, that's a swift move in 10 days, like you just cited. It feels like sentiment in the market is starting to change because you got the Fed doing what investors want, saying the right things, being more dovish. You've got trade moving in the right direction. What's the risk here? We're going into earnings season.
Yeah, so look, I feel like if we limp into earnings season, we kind of get a good bounce because expectations are low. But we're rallying into earnings season, and you know what? We may get a sell-off because of that. So I think the miscalculation some people are making right now is that this is a Bernanke put or a Yellen put. I don't think, even though he's been a lot more dovish, if it is a put, the strike price is way down. So we shouldn't feel so comfortable with that either.
I just want to take the other side of what happens with the Fed.
Sure.
On the last employment numbers, which were incredible, both on the private sector side and wage growth was good. And that was post the 9th straight hike.
Sure.
Some people say, well, you know what? The Fed was right doing the hike in December. Look at those numbers. Right. And some people are getting a little nervous about wage pressure. So
I know, but it's not showing up in inflation, right?
Well, we're not seeing inflation, right. but we have 90 days to get there.
Right. Well, but look, I think the policy, which was, hey, you know what, higher wages is too much money chasing too few goods, that 1965 kind of mantra. And, you know, we have disruptors. We have Amazon. We have Walmart pushing prices lower. So there's a lot of things that are going on here that you can't use a 1965 textbook that says too much money chasing too few goods. It doesn't work.
Well, it also...
That gets to the whole thing. What business does the Fed have trying to calibrate this economy?
Right. We're using their models by their own mission in the December 18th hike, and they're talking about inflation expectations being here, and actual numbers came in here for the last couple of years. So their models are all false, because they kept on saying, well, we think because unemployment rate is this and wage growth is this, that inflation should be this.
Have the predictions in the last 15 years, except for 2 times, ever been right for the next even 12 months? No. Right. They should stop it.
I know, but it's too late because they have a balance sheet that's finally below $4 trillion, $50 billion drawdown every month. Right. The only thing that gave investors solace last Friday and even this week is that they will change course on the balance sheet reduction if need be. Right, so because, again, they're already there, Steve. They're already there.
I love how he says he's worried about the debt. The Fed was the biggest enabler of that growth of the debt by, in effect, buying it after 2009.
They are indeed. They are indeed. They've got the back of all these freewheeling Republican and Democratic congressmen and presidents who just love to spend borrowed money. I don't know why people worship spending out of the government. Yeah. I'm from the government, and I'm here to help. The scariest words in the English language. Thank you, Ken. Ken Mahoney.